inflation rate recently jumped to 4%. The second consecutive month inflation has risen despite rising interest rates. Here to break down what this means for Canadians is Peter Sashecki with Everything Financial. Good morning, Peter. Good to see you.
Good morning.
So what is going on? I mean, why has inflation not come down as fast as we would like to see it? Because we've had how many interest rate hikes now over the last couple of years?
732, I think.
I lost count, but it has been a lot.
It has been a lot, but remember, it takes 12 to 15 months for a raise in interest rates to actually affect a decrease in inflation. And actually, inflation has gone down more than we think it has gone down. The numbers are actually not accurate.
So why is that?
Because the government changed how they calculate inflation and started adding in mortgage payments to inflation. And mortgage payments are actually disinflationary, not inflationary. And they did this to keep inflation a little bit higher. So it's really about 3.2 is what every economist has calculated. But they keep it higher so they can keep interest rates higher a little longer.
So what does that mean for interest rates in the future then?
Well, they're going to have to come down at some point because as inflation levels and does start to drop, you have to drop the interest rates or else inflation will actually go down way too fast, which causes a recession. And then we have a whole other mess of things happening.
Right. Want to try to avoid that, obviously. So let's look bigger picture here, the next 18 months to 2 years. What are we looking at?
They feel that the overnight prime rate by sometime into 2025 or early 2025 or by then, will be somewhere down in the mid threes where it was before, high twos, somewhere in that ballpark. It should be where the government targets are because it takes that long to have these increases effectively drop inflation, and you'd rather have a slow, steady decrease than a quick kind of going down the roller coaster downhill thing where it loses control.
Right. Okay. So let's talk about like mortgages. I think a lot of people, maybe have mortgages coming up for renewal at some point. What would be the best scenario to lock in something more short term? Definitely
short term. About 50 to 60% of Canadians have mortgages maturing between 2025 and 2026.
Wow.
That many.
Because they locked into a 5-year probably?
They locked in, some of them just locked into a 2 recently.
Okay.
Or a 3. A 3 was very popular. The banks kind of know what's going on. They know what's coming in interest rates, so they're not even negotiating anymore. They have those 4 and 5 years lower. They're really trying to entice people to get those 4 and 5 years because they know what's going to happen in the next 18 to 24 months. And they want people to lock in because in years 3 and 4, the banks will make a lot of money with low interest rates and locking you into a slightly higher mortgage rate. So as we've said before, don't panic, take a deep breath, tread water, and if you are maturing soon, go short term because the difference in payment, even though the rate might sound pretty scary, the difference in actual interest cost over the course of the year will usually be quite small, very small.
So for all those folks that do have the mortgages maturing, you said 2024, 2025, what scenario are they facing?
1 year, 2 year.
Yeah.
The rate might be 1% higher, but 1% higher on an average, let's just say $500,000 mortgage, is not like thousands upon thousands of dollars in interest cost. It's very small. And that's the question you should ask. Show me the difference over 1 year, not what sometimes people are shown. Oh, well, if you get that rate over the next 25 years, look what it's going to cost you. Well, you're comparing a 1 year versus a 2 year or a 3 year scenario. So look at the 1 to 3 year scenario in the cost and go, you know what? For a couple $1,000s to get a rate 2 or 3% lower in a year or two from now, that's worth taking a chance.
All right. Good advice this morning. Peter Sashecki, Everything Financial. Thanks, Peter.
Thanks.
Thanks for coming in.